A very good afternoon and good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. If you could just let me know you can see my screen and hear my voice okay, that would be great. Yeah, thank you, Johan. That's super. Hi, Josh, Mohammed, Warren. Good to have you here, guys. Looking forward to taking us through this session and really making sense of these markets so that we're in tip-top condition. We're also going to be getting ready for the Bank of Canada meeting, which is coming up later in the US session. So we'll get us absolutely ready for that. Just as folks are coming in, a few things to say. So first of all, don't forget the disclaimer. As we talk about different entries, exits, the whole idea of this webinar is educational perspective. It's not meant to be a signal trading service. Those of us who are regular are well aware of that. And what we're going to do, we're going to start by getting straight into the Bank of Canada interest rate meeting. Now, the Bank of Canada meeting is going to be an interesting one. Now, first of all, no particular changes expected, but here's what we need to look for in case we do get some opportunities. Now, I'm just going to switch over to my other chart so I can show you the context of this, because more often than not, it's context which really makes sense. Let's see which. Okay, right. Now, just taking a look here at the recent moves in the CAD. If you just look, heading into the last interest rate meeting for the Bank of Canada coming into October, do you see the way the CAD, the pink line, strengthened? Well, that's because we saw some really good data out of Canada, and the CAD strengthened. Now, when we had the interest rate meeting, yes, the Bank of Canada was more hawkish. They surprised markets by finishing their tapering, but we saw the CAD move sideways, and it was only because a lot of good news had been priced in heading up to the meeting. We were expecting to see similar kind of sideways actions that we saw with May's meeting when there was a hawkish twist from the Bank of Canada before a pop higher. We've seen exactly what we expected. Now, a couple of things to say about this. We had some very good jobs data out of Canada last Friday. I think it was about 140, 150,000 jobs added. About 73,000 of those were part-time, 73,000 odd were full-time. I haven't got the total numbers right, but it's a roughly, it was a well above maximum expectations. It was about a 70-70 split in terms of full-time and part-time jobs. In other words, fantastic. So we've been seeing some CAD strength, and don't forget the CAD has been pushing higher recently with oil prices just moving a little bit higher as volatility has been moving lower in oil. So oil's been moving higher, finding some support around that 66 region. OPEC agreed to sort of stay on hold and, would intervene if necessary as the Omicron variant fears were going, really emerging across markets. Today, we see further downside in volatility, and these moves higher in volatility is what was really harming risk assets. We are now seeing volatility just moving to the downside, and that is supportive of assets generally. So the CAD now comes into a very interesting point. Now, going back to our main screen, this is what we need to see. The Bank of Canada is focusing on a couple of things. One is going to be the Omicron variant and how much that impacts Canada. And remember, this is going to be largely due to the oil market for Canada. One of Canada's biggest export is oil. So in other words, if it's positive news for Omicron, that will also be positive news for CAD. We also want to see how the Bank of Canada feels about inflation. Now, there's two different camps here. There's the central bank that thinks that inflation is transitory. So that's the Reserve Bank of Australia. That's the Reserve Bank of New Zealand. That's the Bank of England. And that's the European Central Bank. But then there's those that think that inflation may be more worrying. The Federal Reserve has made a slight move towards that position with Jerome Powell, dropping that term transitory in his communication about inflation. So in other words, the Fed have just moved back from that transitory inflation idea, or they've moved back from the transitory inflation language in order not to confuse markets. For whatever reason, the bottom line is they're pulling away from it. So why is that a concern for us? It's because of this. Because if the Bank of Canada show concerns about inflation pressures, the only real tool a central bank has to control inflation is by hiking interest rates. So that would be positive for the CAD. So this is what we need to look for. If they say that Omicron is a risk, but is not going to change their view, that's going to be seen as positive. Now think of the Reserve Bank of Australia. The Reserve Bank of Australia met this week, and they acknowledged Omicron as a risk, but downplayed its importance. That's been positive for the Aussie. Secondly, one of the criteria that the Bank of Canada has set is they want to see the output gap closed. In other words, they want to see the gap between what the country is producing and what the country is using. They want to see that closed. So if the output gap closes, and if they expect that to be closed by the first quarter of next year, that's bullish and will give us indication that they may be hiking in the first quarter. If they have concerns about Fed calling for a more aggressive policy stance, then that would be upside for the CAD. So the expression, the pairs to look for will be dollar CAD downside, pound CAD downside. Now, the pound CAD downside is because at the moment there's growing concerns that the UK is going to have to make further Omicron variant allowances today, and it's going to have to use its so-called Plan B. So that's going to be folks working from home. That's going to be potential COVID vaccines to get to large-scale events, etc., etc. So that's been negative on the pound. So a hawkish Bank of Canada. Best opportunity, short-term spike in the pound CAD. That would be a really good opportunity. Now, if they're dovish, if they say Omicron poses a big risk and it's pushing back expectations of the output gap being closed, and that would signal that a first half of 2022 rate hike is not coming. If they stress that the recent push low in energy prices is enough reason to stay patient with price pressures, so in other words, they said, look, oil markets can fall and they can rise, and we're not concerned that inflation is going to be getting out of control, that would also be a negative. So then we'd look at something like the Aussie CAD or the New Zealand dollar CAD. Now, the reason we'd like the Aussie CAD is because the RBA met this week, and I'm just going to go over to show you what's going on there. So if we just look at don't forget, do use my blog. It's a very good blog, and I do keep it up to date with latest developments. And you can see here, I just looked at the RBA, and I said past peak bearishness now. Okay, so on the face of it, the meeting was very neutral, cash rate the same, the QE program the same. They're not going to talk about that till Feb next year, but they said the Omicron variant is not expected to derail the recovery. Now, the message that stood out to me, it wasn't what they did say, it's what they didn't say. So if you notice, the message before this one was much more like, dovish. It was hawkish indeed, that they did stop the yield curve control of the 3-year bond, but it was a more dovish in message. This was not a dovish message. So the neutrality of the message is in itself a message. So I was looking like this may be very good for the Aussie, and we could see some Aussie yen pairs looking liable for extra gains. It's also worth looking at the Aussie New Zealand dollar potentially for extra gains. So, a fairly decent swing trade. Obviously, this is dependent on the Omicron variant, but it's Aussie yen. And you can see that looking at that near-term support, it just meant that, support can be found here. So it's a fairly sensible place just to look at markets. And if you look at the bond yield spread here between the Australian 10-year and the New Zealand 10-year, you can see that that's a really decent you know, this bond yield spread, yes, it's still low, but we could see that be the lowest point, and we could see the Aussie 10. No, not. Sorry about that. I'm using the wrong bond yield spread. I want the Aussie 10-year versus the Japanese 10-year. That's it. Now this should be better. Apologies, folks. Right. So you can see that there's a gap here, and prices tend to follow the yield spread. You see how the price follows the yield spread. Now this yield spread, yes, it's been dropping lower because we've had the bid into the yen on the Omicron variant fears, but look, the gap's still high, and this is expected to pivot higher because of the more bullish potential outlook for the Australian dollar. Now, on top of that, the other benefit for the Australian dollar, remember, is the fact that People's Bank of China, they reduced the reserve ratio requirement, the amount that banks have to have in reserve before they can lend. They reduced that by 50 basis points. So it means it's easier for banks to lend. They've also, on top of that, made conditions more accommodative for small businesses and for agricultural businesses in China. And on top of all that, there's also been some pretty decent moves higher in commodity markets. In particular, if you notice the iron ore and coal markets. So iron ore and coal make up around a third of Australia's entire exports. So that recent drop in iron ore is starting to recover. So coal prices have been elevated, are moving higher. Iron ore prices are moving off their lows. Now, all of this means that the sort of trade balance proxy that we're using here, which is the combination of iron ore and coal prices, which is the white line in the middle, is pointing to the upside. So, in other words, there's a number of factors that potentially do support the Australian dollar, Japanese yen. And the latest interest rate decision by the RBA was good. Now, look out for employment. Uncertainty about behavior of wages as an employment rate declines to historic low levels. So bear that in mind. The next unemployment data print will be next week. So if Omicron fears fade and Australian labour data picks up, then the Aussie may be well placed for a decent recovery. Okay. And there was this long-term RBA watcher, McCran. I did talk about that on my Twitter feed. I'll just show you that here. You just have a look here. Here, RBA watcher McCran says, after the latest RBA board meeting, it's clear Australia is moving closer to a rate rise, possibly even relatively early next year. Okay, so what I'm trying to say is there's some more positive forces building now for the Aussie dollar. So be aware of that going forward. So the Aussie CAD could be a very good trade if we get a very dovish Bank of Canada. Okay, so a dovish Bank of Canada, then Aussie CAD upside will potentially make sense. Now, the other thing to mention, apart from the Bank of Canada interest rate meeting, is the latest headline we've just had from Pfizer and BioNTech, right? So if you look at this news, Pfizer and BioNTech say 3 vaccine doses neutralize Omicron variant. Good news. 2-dose vaccine may still prevent severe disease. Good news. But less effective significantly at neutralizing Omicron. So we have needed some virologists and immunologists to give us some comment about the new Omicron variant. And one of the key headlines we've been looking for is vaccine efficacy against the new variant. This is the first really positive news. Medium term, this means that the vaccine is going to be significant. And it's not going to totally derail, the Omicron variant is not going to totally derail the recovery. So that means medium term, subject to any other news, like New Zealand dollar yen buying just makes sense at market now. Stops can be just below the 75. This is a trade I'm in, so I am in this trade. New Zealand dollar yen, the RBNZ expected to raise interest rates to 2.6% next week. No, not next week, sorry. Oh, that would be a fine thing. The RBNZ are expected to raise interest rates to 2.6% by the end of 2023. They're currently at 0.75%. So the RBNZ are on a rate hiking cycle. So we would anticipate to see this Jaws gap between the New Zealand dollar yen and the bond yield spread between the New Zealand 10-year and Japanese 10-year yield spread close, right? We're now seeing momentum tilt to the upside on the indicators. So, technically, fundamentally, and positive Pfizer BioNTech news, this does make sense to go long the New Zealand dollar Japanese yen. Now, on a weekly chart, the obvious place to put your stops would just be below 74, just below that 100, 200 exponential moving average, and we're looking for a retest up to that 82 region. Now, as I said, I am long New Zealand dollar yen, and I am also short Euro New Zealand dollar, and I'll explain the rationale why this is also appropriate for shorts. Now, the Euro New Zealand dollar, the reason the euro strengthened recently on the Omicron variant fears is that the euro is a funding currency. It has very low interest rates alongside the Swiss franc and the Japanese yen. So if you just go over here, and can you see, like going back to remember the Omicron variant news broke around 29th, 30th November around US Thanksgiving? So if you notice, going back to like 29th, 30th of November, if you notice, let's just get this right. Let's just see. Well, what we saw around that time, the Swiss franc and the yen and the euro all strengthened significantly. Now, it's noticeable that a lot of that strength has dissipated now. So this doesn't show what I wanted to show. But if you look on just actually the chart here, going from November the 30th, and you see the Swiss franc, see how strong that was? From the 30th of November, see it went higher. See the yen, that moved higher, the green line. But also notice what I wanted to put out was the euro. See the euro, see the strength it went from like the 29th of November through to the 3rd of December. That strength was similar strength as the yen and similar strength as the Swiss franc, right? Now that is because of the funding currency status of the euro. So in other words, as soon as risk markets turn positive again, that funding currency status will come back and traders will be selling the euro. Now, the New Zealand dollar, we've already discussed, is on a rate hike path. So we would expect the euro New Zealand dollar pair to be moving lower. And if we just look at the bond yield spread between German 10 years, take away the New Zealand 10 years, that's the reason we use the German bond is because the euro doesn't have its own bond, right? So we use the German bond as a proxy. And remember that the German bond, remember that the country of Germany is the largest member of the European Union. So that's what traders use basically as a proxy. And notice this, do you see? The bond yield spread is still low, right? So in other words, it's reasonable to expect more downside. Stops can be placed above that 1.6800 region. And for more conservative traders, stops can be above that 1.700 level, above the 100, 200 exponential moving average. So Euro New Zealand on the downside does make sense medium term for a similar reason. Obviously, this will depend what's happened. This will depend what goes on with the vaccine news. Okay, and we have to keep a careful eye on what happens with the vaccine news. But medium term, that does, and that's just happened 45 minutes before this webinar started. So it is breaking news and would make sense and is more positive for risk. And notice that we started to see that more positive news coming for risk with, let's just have a look. Just one moment. Just look at the bond, the volatility moving lower across major markets. Volatility in the crude market moving lower. The VIX for stocks, that's for oil, and bond volatility still a little bit elevated, but generally speaking, volatility has been dropping off those high levels, and that has been positive. Okay, folks, a little bit of progress from me is I've just launched my own website, so I'll let you have a little look at that as well. So do come and check out my new website, and that's been a new bit of good progress for me. So do check that out. And apart from that, the crude EIA data will be released. And what we're going to watch for that is there is, and let me just think, there was a draw last night of around 3 million barrels. So what we need to see for this oil to move upside further is we want to see a draw of greater than 3.5 million barrels today. So if we see a draw of greater than 3.5 million barrels today, expect more upside in oil, but also expect oil to be supported on a positive Omicron variant news, and any negative Omicron variant news, expect oil to be moved to the downside. Simple reason is if everyone's ill again with a virus, they won't be using vehicles and cars, and there'll be more lockdowns and restrictions. Okay, folks, so I hope that helps. We've been short and sweet today, but we've covered lots. If there's any questions, please do quickly ask me a question now. Apart from that, I hope you have a very good rest of session. Is there anything anyone's unclear on or wants a little bit of help on, do just message me now. Are they looking for number 6?
Yes, mate.
I'll be down in a second.
Okay, Bob.
Okay, folks, that's great. Thank you all very much, and look forward to seeing you on Monday. Take care and have a very good rest of the week. Goodbye.